The benchmark interest rate in Japan has been recorded at 0% again. Interest rates in Japan averaged 3.15% from 1972 until 2014, and they look set to remain exceptionally low, which is creating a determinedly strong yen. This is today's interview, and I'm Kiri Bloor. Joining me on the phone lines is Frederik Ducrozet from Crédit Agricole Corporate and Investment Bank to find out how sustainable the monetary policy is. Hello, Frederik, and welcome. Interest rates stayed at 0% again. Do you think this rate will stay for a while? And many think it will be the UK that increase interest rates first. What are your thoughts?
Well, it's pretty clear that the Bank of Japan will leave interest rates on hold for quite some time. Actually, the question and the debate among investors is whether or not the Bank of Japan will add to unconventional stimulus this year, quantitative and qualitative easing for that matter. This question has actually shifted in the investor's mind recently after the Bank of Japan minutes in particular revealed that they were not about to ease policy much more. But in terms of interest rates, at least, that's pretty clear that the base rate of the Bank of Japan will remain on hold for at least another couple of years.
At its May 30th meeting, the Bank of Japan decided to keep flooding the economy with new money at the same rate as it has been, despite tepid industrial production data and recent sales tax rises, as the central bank considers it can grasp a 2% inflation target by next year. Do you think this is the way to go, and can they reach their target of 2%?
That's indeed the central question, whether the Bank of Japan can manage to sustain a higher rate of inflation and core inflation. The first stimulus, the first step, I would say, was easier than the second one, with the Abenomics and third arrow of the Abenomics in particular. More challenging so far, and the VAT hike hitting the economy. So in this current context, the Bank of Japan is actually quite confident that it will reach its target, which is the reason, by the way, why people expect lower probability of additional easing right now. We think that everything will hinge on the wage growth in the very near term, because this will be the driver for inflation over the coming quarters. And so far, for large companies, there has been evidence of wage increases to come. This is unclear whether it also happened for SMEs in particular, and that's why I think the next wage reports on wage growth to be released on June 3rd will be very important to the BOJ outlook.
Asian stocks fell for a fourth day, with the regional benchmark index heading for its longest losing streak since January, as the yen strengthened and the Bank of Japan refrained from adding to monetary stimulus. What other knock-on effects can we see around the world?
I think it comes from several channels and transmission channels. The first one being, obviously, as usual, a global risk aversion phenomenon, which can also have some contagion effect through other Asian places. But from a more domestic Japanese point of view, I think that the FX market is another transmission channel that will be very important to the BOJ, given that the Japanese yen, the currency, is at least part of the policy targets. And I think this kind of vicious circle, vicious spiral, where you have the stock market weakening and the Japanese yen appreciating, if anything, on repatriation flows, is something the Bank of Japan will monitor very closely and will not welcome at the current juncture. So I think if you have an extension of this kind of risk aversion for another couple of weeks, if not longer, that's something that could actually trigger some reaction from the Bank of Japan eventually.
Do you think the spending spree before the tax hike gave a false sense of strength economy to the Japanese?
It certainly gives a false sense of strength in the first quarter, given the GDP report that was at least temporarily boosted by this kind of expenses by households and corporations ahead of the VAT hike in particular. You're right. The Bank of Japan, like any central bank will look at forward-leading indicators to assess its outlook for the economic activity. And while this was roughly in line with the expectations, still quite encouraging. Some surveys like the PMI were downbeat, but others like orders or even the Tankan survey continue to point to pick up in investment, profits and consumption in the coming quarter. So to sum up, the second quarter will be weak. There will be a setback after this biased outcome in the first quarter. But looking ahead, there is little evidence of a sharp slowdown in the Japanese economy at the moment.
The Federal Reserve keep reducing their monetary stimulus, but the Bank of Japan are opting for full speed ahead. What kind of movement do you think we'll see between the pairing?
The problem with the pair in the Japanese yen versus the US dollar is that the rate differential is right now not the single driver, if a driver at all, of the currency pair. And that may change indeed the closer we come to the first rate hike in the US, which is likely to happen sometime around the middle of next year. But until then, it's unclear whether it's risk sentiment, risk aversion, the rates differential, or something else that actually drives the current account in particular. I think it's a combination of all those factors, and right now it will depend more closely on stock markets developments in particular rather than the rates differential alone.
And finally, dollar yen peaked earlier this year at 105 but has now dropped. How sustainable is the current exchange rate and what is driving it? Also, could we see a return to this annual peak?
Given the current context, and especially what we said about the stock market weakness at the moment, I think there is a risk indeed that the currency breaks, maybe in the short term, this threshold at 100, which is clearly a risk also for the broader policy settings in the Bank of Japan in particular. Technically speaking, yes, it might then amplify any move below this 100 threshold. Having said that, it's clearly also a policy target not only from the Bank of Japan, but for the Minister of Finance in Japan to have the Japanese yen weaken further to, let's say, above 105 at least, if not 110. And I would say that may be part of the catalyst from the Bank of Japan to add to unconventional stimulus at some point if we have this weakness in the dollar-yen pair. So that might actually be pain, but for good, and that would indeed trigger some policy response that would be in turn welcomed by the market.
Thank you, Frederik, for joining us. That's all we have time for today, but click back for more on retail sales with Ben Jones. But from me, until next time, see you then.